Managing open positions. An open position is simply an established or entered trade that has yet to close with an opposing trade. An open position occurs following a sell or a short position or a buy or a long position, and the position stays open till the time an opposing trade takes place. Open position depicts market exposure for the investor. Until the position closes, there's always a possibility of risk. As an investor or trader, it depends on your style and objective on the basis of which the open positions can be of help from minutes to years. Portfolios comprise many open positions. The volume of risk that the open position carries depends on the size of your position against the account size and your holding period. Generally, long holding periods are riskier as they are more vulnerable and exposed to the unexpected market event. Closing the open positions is the only way to eliminate exposure. If you want to close your short position, then you would be required to buy back the shares. And if you're looking to close a long position, then you would have to sell your long position. Open position diversification. As an investor, you can mitigate your risk by diversifying. An investor can also reduce risk through diversification by spreading out the open positions throughout various market sectors and asset classes. For example, if you want to diversify your portfolio, you can do so by investing into different sectors across the economy, such as finance, healthcare, information technology, pharma, utilities, etc., as well as a few fixed income assets, such as government bonds and treasury bills. It's important to note that allocation per sector is adjusted according to market conditions. However, investors keeping a balanced portfolio can even out the risk. A balanced portfolio means you have almost equal amounts invested into each sector. A great way to close out positions to curtail losses and eliminate exposure of underperforming companies are to use stop losses. An investor is always exposed to systemic risk when holding open positions overnight. An active trader who follows the market regularly might take action during unforeseen price changes. However, it's more advisable to place price alerts to avoid missing out on price changes. Nowadays, most discount brokers provide an alert system right in their apps. Open position and day trading. It's typical of day traders to buy and sell securities within a single trading day. A day trader tries to close all the open positions before the end of the trading day. If they don't close their positions, they're simply holding on to their risky positions overnight or longer. In this time frame, it's possible that the market turns the tide against them, leading to losses for those traders. Day traders typically have a plan and stick to it. Hence, they are disciplined experts. Besides, day traders often have sufficient money to gamble on day trading. The smaller the price movements, the more money needed in order to take advantage of those movements. Day traders also make the most of high leverage that is available only for day trades. Timing of entry and exit. Entry strategy. Suppose you have researched a particular company to determine that its stock is worth investing in. Now the question remains, when should you buy the stock so that you can receive the best possible price within the time frame you're ready to wait for? The professionals refer to the art of timing your entry and exit in the stock market as technical analysis. Technical analysis is about reading the historical chart of the stock price and deriving all the information from it. A trader's ability to read a stock chart can make a lot of difference. Here are a few things you should be aware of in technical analysis so you can trade successfully and strategically in the stock market. Your style of trading stocks. Both investors and traders can use technical analysis. However, your approach to the stock market determines its importance. Investors who think about increasing the value of their stocks over the years require technical analysis just as much as traders who wish to increase value in a matter of days. Hence, both long and short-term investors need technical analysis. But the way of using it can change through your style of trading. Follow simplicity. Generally, for technical analysis, we use a number of indicators. An indicator provides you with information that it derives by assessing the price history from a certain perspective. When you use too many indicators, technical analysis can become an overwhelming and hectic task. But as a matter of fact, you only need to know 5 or 6 indicators to trade successfully. In reality, professional traders have succeeded using simple analysis. Hence, the real secret is simplicity. The simple way forward in the stock market and using technical analysis is to keep things simple. To look for a buying opportunity, you should try to find the support zones. Traders who follow price action patterns can enter after a solid breakout from the pattern, or, to be more subtle, enter at the retest after the breakout. Exit trading strategies. Market timing. Establish risk and reward targets before entering a trade. Find the resistance level which is likely to come into play within the time restraint of your holding period. This will mark your reward target. The next step for you is to find the price where your thesis might be proven wrong if the stock market reverses its direction and hits that price. This will be your risk target. Now, determine the reward and risk ratio. It would help if you looked for at least 2 to 1 in your favor. If the ratio is anything less, you should consider skipping the trade and moving on to finding better opportunities. Focus your trade management tactics according to the 2 key exit prices. Assume that things are going according to your plan and the price is moving towards your reward target. Now, the price rate of change plays an important role because the faster it gets to your desired number, the more flexible and easier it becomes to choose an appropriate exit point for yourself. The first option you have is to pat yourself on the back for a great job and take a blind exit to move on to the next trade. The second option is that you should let the price, which is already working strongly in your favor, exceed the reward target and then place a protective stop loss at that level while you can keep attempting to add more profits for yourself. Then look for the next barrier, staying positioned as long as it doesn't disrupt your holding period. Slow advances are problematic to trade because many stocks will move near but not reach the reward target. Hence, a profit protection strategy is required here that gets going once the price has traveled through 75% of the distance between your risk and reward targets. Put a trailing stop that safeguards partial gains. If you're trading in real time, keep one finger on the exit button while you watch the ticker. The tactic that you need to follow here is to keep your position until the price action sends you a signal to exit. Stop loss strategies. Stops are required to go where they get you out when security defies the technical reason you took the trade. However, this concept can be confusing for traders who have been taught to place stop loss based on some random values, such as 5% fall or $1.50 under the entry price. These arbitrary values don't make much sense because they aren't adjusted to the volatility and attributes of that particular instrument. Rather, you should exploit and take advantage of technical features such as round numbers, moving averages, and trend lines so that you may establish the natural stop loss price. You can also use the trailing stop loss orders to time your exit from the position. A trailing stop loss is a type of day trading order that lets you set a maximum value or percentage of loss you can incur on a trade. If the security price rises or falls in your favor, the stop price moves with it. If the security price rises or falls against you, the stop stays in place. An additional step is required in modern markets for effective stop placement. Now, algorithms target common stop-loss levels which shake off retail players and then jump back across support or resistance. This necessitates that stops be placed away from the numbers that you say you're wrong and need to get out. Discovering the perfect price to avoid these stop runs is more art than science. A general rule says that an additional 10 to 15 cents should work on a low volatility trade. However, a momentum play may require 50 to 75 cents more. If you're watching in real time, you have the luxury of more options, as you can exit at your original risk target and re-entering if the price jumps back across the contested level. Let's see some of the personal trades to learn more about trade management. MSTR. I entered MicroStrategy Inc. around $500 levels after giving a good breakout from the ascending triangle pattern on the 1-hour time frame. The stock had corrected a lot from its high in the June-July period. The formation of a strong bullish pattern, along with huge volume bars, confirmed a change in the direction. I placed the stop loss below the wick of that last green candle at the bottom, which is $475. The next day, the stock gave us a gap up opening of 7% and continued with the strong momentum. It consolidated there for 3 days, then gave another gap of 12% and finally reached $640. At this point, I raised my stop loss to $560. Now, as the huge gap would act as a strong support zone for this stock, by doing this, I had secured some of my profits too. Though I exited the position on the 28th of July and made roughly 30% in a few days, the stock had such a strong momentum that it continued to go further to $800. That makes this kind of return in less than a month something you can't get in any profession except for trading. CURI. Another trade that I recently took was that of CuriosityStream Inc. There was some increase in the company's business activity prior to the earnings release, which made me a little bullish on this stock. Hence, I was already a bit optimistic regarding the company's upcoming earnings report, and the stock proved me right. As you can see on the charts, the stock made few indecisive candles near $10, and it appeared like a reversal. I entered the stock when it bottomed out and formed support around $10. I placed my stop loss below $10 and held on to the trade for a few days. Within 2 days, the stock gave a huge gap up of more than 10%, and my view got even stronger for this trade. I moved my stop loss to $10.80 after this and let it continue. Within a few weeks, the stock was trading at $12.80, and that's how I made around 20% in this trade in less than 1 month. SKLZ. Now this trade is a really interesting one. The stock of Skills Platform Inc. turned out to be a short squeeze candidate. The stock formed a bottom around $10, and I made an entry at 10.60 after it halted at this level for a few days. This area has acted as a support zone multiple times in the past. The huge green candle with rising volumes confirmed the reversal of this stock from here. Multiple factors went behind this trade. The stock had broken out of a falling wedge on a daily time frame. The stock had taken support at $10 and made a bottom there, and it was trading 75% below its all-time high. The short float, the percentage of shares shorted out of total freely traded shares, was as high as 20% at the time. As you go ahead with this course, you'll understand what short float and short squeeze actually mean. A trader on Reddit posted that he got a huge popularity, where he claimed that he had invested $4.8 million in this stock. This sparked a series of positive news for the stock. After the stock got a push from the Reddit post, The stock had a little buzz and made a little leap in the aftermarket cap. By doing that, I could set a higher stop loss and secure my profits. The company had $700 million US in cash on hand on their balance sheet, securing the company existence for a couple of years. Now, all of these factors helped push the stock up, and the shorters started to close their positions. Within a few days, the stock gave a nice gap up opening, and I was sitting at 17% gains. With the right knowledge and understanding, you can easily find such trades, and honestly, even 10% plus gain in a span of a month is great enough. When you compare it with the meager returns on your fixed deposits in your bank accounts, you see the power of compounding and trading.